And then when reading a chart, you want to be simple and understand context. That is, what's the difference between this price and this price? Most people would say nothing. They're both trading 40.41. The difference is context. On this second dot, you look over your shoulder and see that the market just went down and back up. So what's the difference between the first dot versus the second dot? The second dot has less longs, most likely. Less longs equal what? Less longs, people have to know this, has less sellers. Less longs, less future sellers. Less future sellers. That's not just important for the price of anything to go up, it's imperative. It's like necessary. You got to put yourself in a position to understand that. And that's one of the ways to read a chart. The difference, the probability of going up is greater on that dot than this dot. And then you look at context and you could see all the swing highs all in the same area. And at some point, I always tell people when you're looking at a resistance area, the fact that it's a resistance area because it's already been a resistance area means it's less likely to continue to hold as a resistance area, not more likely. Conventional wisdom would say more likely. Knowing what you're doing tells you less likely. So if you're looking for a breakout, you're just more likely to get it on that second dot, even though it's at the same price because of context. Now, take a look at right there. It's already showing you 599 by 166. So this guy is already less than 200, which is kind of a benchmark what we look at. Less than 200 of offers or sellers above, because all these guys above price are future sellers, and these guys are future buyers. If you get future buyers to get out of whack over future sellers, it's obvious that upside's probably right side. It's, again, something needed for the price of anything to go up. But these numbers are not just taking all the numbers on your depth of market price ladder, adding up the 10 best bids, adding up the 10 best offers, and giving you the totals. No, those orders are generally BS. All right. They're there to hedge, they're there to spread, they're there to all kinds of things. You got to be able to filter and be able to qualify a real order from a bullshit order. The bullshit order is going to hurt you, not help you. But we found a way by tracking orders that shift, change, as much more likely to be real. And so by doing that, then we add them up and compare and contrast them. And that's the numbers we're getting down here. So what this does is give you a when moment, a better when moment. When's it going to rally? When's it going to pop? And it's when the market gets below, close to below 200. I'll back it up a few beats. If the music's playing on the TV show you're watching or the movie you're watching, the music plays to start focusing your attention and build up the drama that something's going to happen. And the something that's going to happen in this context is a breakout, a pop, a rally. How do I get long? Take a look at that. This is getting and staying below 200. Here, instead of, and I'll fast forward it, boom, instead of here, this does you no good. This is where little Johnny says it's going to rally. That's where little Johnny says it's going to break out. That's where little Johnny says, oh, the resistance is no longer resistance, mommy. Little Johnny might be a good kid, but he's a shitty trader. And so the market gives you that element of more buyers and sellers, a breach of when there are more sellers. Bam, it takes it out. Iceberg, all this other stuff. But the key is the context.